Welcome back. Thanks for staying with us on Money Talks. Well, in today's show, the focus is on commodities. And in the second half of the show, we'll be taking a closer look at oil. Well, world oil prices are in the spotlight again as tensions rise in the Persian Gulf. There is growing concern that Iraqi oil exports could be halted amid the crisis over arms inspections. ABN Stuart Pallister has more.
Uncertainty about the Iraqi crisis and the possibility of military confrontation is plaguing the oil markets. And then there's uncertainty as to whether the UN deal, allowing Iraq to export oil for food and medicine, will be put on hold. So far, the verdict is that the crisis won't escalate.
I think the oil markets are guessing that if there was going to be military confrontation, it would have happened by now.
Analysts say that if the confrontation had been serious, Iraq's oil exports would already have been blocked. But that's not to say delays aren't in the pipeline.
We think that the food for oil program will continue into next year. However, we expect a delay in December at the rollover period. So that will potentially take some oil out of the market for some time.
But that would only have a limited impact as oil supplies are currently in abundance. And there's talk that OPEC will raise its export quotas to make up for any shortfall.
The oil markets are actually oversupplied. There's too much oil in the market. But were we to lose Iraq quite suddenly in that potential 1.1 million barrels a day, then we could see quite a rapid spike in oil prices.
Crude prices did go up sharply after tensions began to heat up, but they've come off their peaks in the past few weeks.
I think one of the issues why oil prices haven't gone up even more is that if there is some military action in Iraq or in the Middle East, for the time being at least, people don't think that's going to disrupt supply per se.
If it does come to military conflict, prices could soar. But if the crisis cools, oil prices once again could settle down. Stuart Pallister, Asia Business News.
Well, back now to our guests here in Singapore. Tom James, Regional Manager for the Asia Pacific with Credit Lyonnais Rose Derivatives, and also joining him in our studios here, another energy market specialist, Jorge Montepique. He is Editorial Manager for the Asia Pacific with Platts. Gentlemen, both of you, good to have you on. Thanks for joining us today. Just quickly off the top, outlook for oil. Let's take a short-term view. Let's say the next quarter, the next season. Tom?
Well, we've seen oil prices rising recently, both for seasonal factors, winter demand out of Europe, America, and a little bit out of Asia, and also due to Iraqi tension as well, with Iraq playing games with the United Nations again. So we've had that recently, but prices look a little bit overvalued now, and we started to see the Iraqi UN tensions easing slightly, so now we're coming back down towards more better levels for the market, really. So looking into next year, we'll probably see the market January, February, March time slipping back off, maybe another 10% or so from current levels.
Okay. Jorge, there seems to be recently, or currently at least, a pressure on prices. OPEC due to meet pretty soon. There's a lot of talk that they want to raise quotas for next year.
Yeah, the demand for oil has steadily been increasing worldwide. But I also think that the producers have been increasing their production in line with demand and perhaps even surpassing it. So it comes a little bit surprising that some of the OPEC producers are asking for increased production because you may have actually a little bit of a price decline next year.
Wouldn't that be sort of shooting themselves in the foot, or why are they doing that?
Well, in a way, they have a tendency to do that for a number of years. There was a general price increase in 1996, which was unexpected in the market, maybe by about 10%, particularly due to the increase in refining capacity in Asia, which increased the demand for crude oil. Now, this year, despite the tensions, the running average for prices is about maybe 6% lower than last year. Now, with additional production from OPEC and maybe a decline in the rates of growth in Asia, you could have less demand coming in next year or not meeting the expectations. So in fact, you could have a little bit of downward pressure. And there are a few other sources of supply that are coming in throughout the world. Hibernia Field in Canada and some of the former nations of the Soviet Union. So they're also increasing production.
Okay, sound like you're a little bit more bearish than Tom. Do you think he's underestimating how bad it's going to be, or pressure on prices?
Well, in energy, I think it is fair to say that volatility reigns supreme. But as the trends look right now, and particularly if you look at the impact of Iraq's saber rattling over the past 3 weeks, the impact on oil markets from his noise, essentially, hasn't been excessive. In previous years, when he tried to do this kind of game
sort of
all
stunt,
the time,
yeah,
I saw a sharp increase in the prices of jet fuel, for instance. Last year he did the same thing, and the previous year he did the same thing.
Exactly. Why is it different this year, though? What does the market know that we don't, perhaps?
I think it's just become predictable. I mean, it's almost like we put it on our calendar. Well, Saddam Hussein should pop up around now and do his saber rattling, and the US will bring their fleet in, and there'll be some, talk in the UN, and then it'll all ease away.
It's almost discounted or priced in then.
So I think people realize now that there isn't anything Iraq can really do. They have, still significant ground troops, but they don't have the air superiority they did have when they took Kuwait over initially.
Right, but
there's no bite to their bark, so to speak.
We're talking on average, what, 800,000 barrels a day, is that right?
Yeah, around
about 500-600,
500-600. I mean, how much difference really does that make, whether it is there or not, to prices?
It is a significant difference, but Saudi Arabia has indicated more or less that they were ready to increase production a little bit to compensate for the loss. But I think what it is important is the fact that the demand emphasis is not there currently. There are not a lot of refiners running around looking for crude right now. Because this winter, when typically the demand rises, the demand is not rising as expected, and the amount of product inventories held by the refiners is pretty high. In previous years, when Saddam, popped out of the box around October or November, the price of jet really skyrocketed, maybe jumped by 10-15% in a matter of weeks. But this year, there's ample jet in inventories, jet fuel in inventories. So the upside is not really there.
And what Jorge touched upon earlier about with Southeast Asia, there has been a big increase in refinery activity or refinery expansion capacity. But at the same time, we've had the currency turmoil, other economic problems in the region, and we've seen a sudden drop in the domestic demands. People not driving their cars, having to sell their cars, etc. So
it's probably going to get worse over the next 2-3 years, possibly. But I mean, that's overall demand. How much of a hit will demand take because of currencies plunging, and therefore buying, taking more to buy US dollars worth of oil?
I think the key thing now is that Asia in the last 12-18 months has become the second largest area of oil demand, energy demand. It's surpassed Europe. It's second only to America now. So what happens here is now more of a focus than, say, 2 or 3 years ago for oil traders around the world.
Interesting. Okay, let's get to the bottom line here. This is a personal finance and investment show for the small player, for the small investor. Is there any way he can make money out of this situation of pressure on prices continuing?
Well, they could, if they have sufficient funds and sufficient time, they could look into investing into the futures markets here in CIMEX for Brent, or Brent in the IPE market in London, or NYMEX, which is the biggest one of the largest commodity markets in the world, in New York. But that's very time-consuming, and you need to really study a lot about the markets. The easiest way is through futures funds, which are starting to promote themselves out here as the regulatory framework has come about to enable the marketing of them. So that whereby you just deposit money sometimes they're specific to a particular commodity, or they invest in various different commodities. So there's an entry point there. Probably the safest way, if you're just a private investor, is to use options on futures. It's almost like you just pay a premium, just pay a little bit of money, like an insurance premium sort of thing, and that's the maximum that you could lose in the market. If the trade went totally wrong, that's the maximum you could lose. You couldn't be called for any other money. So that would allow you to make some sort of view on the market with little risk.
Okay, but in terms of investing time frame for the small man, are we talking 3 months, 6 months, a year, or?
Probably you're looking at the next 1 month, 2 months, something like
Very
this.
short term, then.
Yes, because of how sensitive oil is politically and otherwise in the world. You start looking at 6 months and beyond, and then you're looking into a whole different ball game. Within 1 or 2 months, you can use charting methods. You can use computer systems maybe to help you out with making an investment decision.
Okay, well, let's take a short-term 3-month view then, just real quickly, last one before we wrap up. What are prices going to look like, say, beginning next year, January?
Well, next year, January, as I say, I think generally the oil price should be easing from current levels. January, February time, normally we'll see markets pretty stable. It's around March, April, May time you'll be looking for markets to drop as refiners, you start to see the springtime, refiners start to do maintenance, so the drop in demand there as well.
Okay, quickly, Jorge, does that sound about right?
Yeah, prices tend to typically on a seasonal basis peak in December or early January. So pretty much in line. You could see if the winter in Europe and North Asia proves to be cold, you could have a little bit of an upside coming in. Okay. The weather so far doesn't seem to be showing that, probably because of El Nino. But one could expect that, and then after early January, you see the seasonal decline.
Okay, good stuff. Gentlemen, both of you, thank you so much for joining us. Good to talk to you. Thanks for coming on. And that's it for this edition of Money Talks. I'm Martin Sung in Singapore. Thank you for watching today.